This video is brought to you in partnership with Stake. If you're in Australia, transfer at least $1,000 worth of Aussie shares across to the Stake platform and get 12 months of free brokerage. Stake rewards, terms and conditions apply. Despite rising roughly 20% in the past few weeks, Tesla's stock price is still down 45% from its high in December of last year. Over just a few months, investors have almost cut the company in half, with it now hovering around an $850 billion valuation. Elon Musk is rapidly falling out of favor in the media with his push into politics, and investors aren't happy. His closeness to the US president, support of Germany's far-right party, and an unfortunate couple of gestures which may not have been Nazi salutes but were definitely perceived as such, have led the general public to kind of turn against him. And this has had a really significant flow-on effect into Tesla. As crazy as it is, some people have turned to burning Tesla superchargers, spray painting Cybertrucks with swastikas, wheels are being stolen off of Teslas in parking lots, and the scariest one, shots have been fired at a Tesla showroom in Oregon. The public are turning against Elon Musk and Tesla, and so are investors, in what is the most rapid reversal of sentiment I have ever seen in my time following the markets. After the US election on November 5th, Trump's victory sent the price of Tesla surging, up around 90%. Elon Musk was celebrating, the stock price was soaring, and his wealth exploded. The world's richest man got a heck of a lot richer, with his wealth hitting a staggering $486.4 billion on December 17th. Elon Musk was king of the hill by a very, very long way, but that's where it all changed. On the back of a questionable gesture and some flavorful tweeting, Tesla stock fell hard. Peak to trough, Tesla lost over $800 billion off their market cap, and currently Elon Musk's wealth has declined by, drumroll please, $143.5 billion. For context, that's more than the entire market cap of Boeing. You know that company that makes like 500 of these $100 million planes every year? Yeah, just delete it. That's how much Elon Musk has lost in the space of a few months. In fact, the Tesla decline was getting so sharp that on Thursday the 20th of March, Musk held a surprise all-hands meeting that was live-streamed to the Tesla YouTube channel to try and get some positive news out into the world in what many are calling an attempt to stabilize the stock. Myself and Hamish spoke about this in depth on the Young Investors podcast recently, but it was basically a 1-hour presentation on why Tesla's future is so bright, and in it, he actually told attendees that in his view, Tesla will be the most valuable company in the world by far, and they should hold on to their Tesla stock.
And some people like Cathie Wood at ARK Invest do see the future. So what I'm saying is hang on to your stock.
So things were looking a little bit desperate, but interestingly, the live stream did work. Since the 20th of March, Tesla stock is up around 12%, which if anything, just highlights how volatile the situation currently is. But what I found really interesting is that in that live stream, Elon did actually raise a good point about Tesla stock and its volatility, and he even used a Warren Buffett analogy. The
stock market it's a very strange thing. I think it's Warren Buffett's sort of metaphor or analogy is stock market's like having someone stand at the edge of your property or your house and yell prices to buy or sell your house every day. And like sometimes they take their meds and sometimes they don't. So sometimes the person yelling out the price of your house is having a good day and sometimes they're having a bad day. But it's still the same house. It's literally still the same house. So Tesla stock goes up and it goes down, but it's still the same company. It's just people's perception of the future. I don't know, I guess it's just very emotional.
And while I do question the motivation behind this whole event, what Elon Musk says there is true. He's talking about Benjamin Graham's Mr. Market analogy, which simply explains that there's a difference between the stock's price and its value. The price is set by Mr. Market, who might be excited one day or depressed the next, but what investors are really concerned with is what the business's value actually is. And this depends not on mood, but on business performance. Then, if the value is calculated to be above the price, well, long-term Buffett-style investors will be buying, but if the price is much higher than the value, then we'll simply leave it alone. Investors will wait for the day that Mr. Market forgets his meds and offers it to us at a very depressed price. But with Elon talking about the fluctuating value of Tesla, even hinting that long-term investors should hold on to their stock, that kind of leads to an important question. What is Tesla stock actually worth? And this is where you start to understand why Tesla is so volatile all the time. But first, I need to explain exactly how investors calculate the value of various businesses. And the most common way is the discounted cash flow analysis. Now, I'm not going to get super technical here. We do teach this in Introduction to Stock Analysis if you want to learn more about it. Links are in the description if you want to check that out. But to try and explain this simply, you imagine you as the investor are going to buy the whole business. Then as the owner of the whole business, you get to keep the free cash it produces each year, called the free cash flow. Then what you do is you model out 10 years of free cash flow that you, the owner, are likely to receive, considering the likely growth of the business over time. And you also imagine that after 10 years, you'll sell the business. So you outlay some money now, you receive 10 years of free cash flow payments, and then you receive a big lump sum at the end when you sell the company. Then from there, your next job is to discount each of those future cash flows by the annual return you want to achieve each year, say 15%, to then figure out what each would be worth to you standing here in the present. For example, if you guessed that you'd be likely to receive $100 in the 8th year of ownership, you'd only want to pay $32.70 for that today, because that would equate to you receiving a 15% annual return on your $32.70 investment. So you discount every year of future cash flows and you discount the sale price after 10 years to what it would be worth to you sitting here today in the present. Then you add up all of those discounted cash flows and you have your intrinsic value, the fair value for the company today for you to achieve, in this example, a 15% return each year. And that's how it's done. But here's the kicker. How do you know what each year's free cash flow is going to be? Well, truth is, you don't. You're guessing. You're doing lots of research into the company, looking at the history of the revenue growth, the net income growth, the equity growth, and the free cash flow growth, and you're trying to figure out how quickly you believe this business could grow its free cash flows in the future, based on its past and its future plans. And in the valuation process, the growth rate you apply to the business's free cash flows over the 10 years that you model out will have the biggest impact on your end result out of anything. That's the thing that really changes the valuation result. And that's why Tesla is so polarizing. Some people apply a massive growth rate to the current cash flows. Tesla will be huge in the future. Others think full self-driving is a dream, Optimus is silly, and they give it a growth rate of a traditional automaker.
But for me, while it's difficult to predict how things will be from, in the next, say, 6 to 12 months, if you say where will things be in 3 years or 5 years? The future of Tesla is incredibly bright.
But at these kind of valuations for Tesla, everything has to go right.
Tesla has been egregiously overvalued for the last couple of years.
There are these cult stocks where what's happening at the company and what's happening in the stock are two very different animals. Most obvious example, Tesla. They'll pay anything for Tesla.
Elon Musk says Tesla is going to be a monster company in the future, and his critics on CNBC say the company is hideously overvalued. And this difference in sentiment is all down to the difference in growth rate used in the valuation model. But one interesting thing we can do is we can reverse engineer the valuation equation to see what growth rate Tesla would need to show annually over the next 10 years to justify buying the shares at its current market cap. Now, Tesla, despite generating $97.69 billion in revenue over the past 12 months, has only produced $3.58 billion in free cash flow, so not very much, to be honest. And assuming we're able to sell the company at 20 times free cash flow in 10 years' time, this means to make the company's intrinsic value match Tesla's current market cap, Tesla would need to grow their free cash flow at 43 to 44% annually. And in fact, back when the stock price peaked at $480 per share, for investors to justify buying at that $1.42 trillion market cap, Tesla would need to show a growth rate of 52% annually for the next 10 years. And that begs the question, is that even possible? Well, to be fair, Tesla has achieved extremely high growth rates in the past. Between 2018 and 2023, Tesla grew revenue at a compound annual growth rate of 47%. So the idea of big growth isn't unheard of, but here's the catch. Free cash flow is a bit trickier than revenue. Free cash flow takes into account all the costs of running and expanding the business, things like factories, R&D, equipment, and everything else. It's what's left over after all of that. And unlike software companies, Tesla is still a very capital-intensive business, so sustaining that level of free cash flow growth year after year becomes incredibly difficult unless the business becomes wildly more efficient or it starts generating substantial high-margin cash from other sources. And that's the argument from the Tesla bulls. The primary argument is around full self-driving. And this is a very interesting idea because it would be an incredibly high margin business. It would turn most Teslas on the road today into fully autonomous vehicles, and it would unlock the possibility of the robotaxi system. Now, this completely changes the dynamic of the company. At the moment, they are basically a hardware company. They sell cars. But if they can start selling lots of full self-driving subscriptions, then all of a sudden they're a software company too. And the beauty of software is that once it's developed, the cost to deliver it to an extra user is close to zero. It's incredibly scalable. Think of it like Microsoft selling Windows. Sure, it takes billions to develop, but each new download is pure profit. Tesla currently charges $8,000 for full self-driving, or a $99 per month subscription in the US. Now, if FSD actually becomes fully autonomous and eliminates the need for a human driver, it becomes incredibly valuable, arguably worth even more than the car. The best way to conceptualize the value of FSD is to imagine you're an Uber driver or a delivery company, and this replaces labor. You'd be willing to pay a lot. In that instance, Tesla creates an entirely new, very high margin business segment. And this is where it gets tricky to value Tesla, because it's quite likely that this will start hitting Tesla's financial statements over the next 10 years. That means investors valuing the company have to figure out what FSD is likely going to be worth to the company over the next 10 years. And it's also why you get super high valuation targets from firms like ARK Invest. They currently expect Tesla shares to be worth $2,600 in 2029, 10 times the current share price. Their controversial CEO Cathie Wood estimates that the robotaxi business could account for 90% of Tesla's earnings come 2029. In fact, they note that without the robotaxi network, their price target would only be $350, only slightly ahead of where it sits today. It's kind of like Nvidia 4 or 5 years ago. Nvidia used to make all of its money from selling graphics cards to gamer nerds. And then in 2020, 2021, people started to realize that Nvidia is going to add a whole other revenue segment in the next few years. They're going to sell chips to companies that want in on AI development. Now, at the time, Nvidia's PE rose dramatically. It stayed around 70 to 80 in 2021. But looking in the rearview mirror now, it didn't matter that investors were buying an overvalued stock for what it was at the time, because that AI business in the years since has lifted their earnings so dramatically that the share price back then looks incredibly cheap today. And that's what the bulls see with Tesla as well. And that really leads us to the big question: what is Tesla actually worth? The share price is extremely volatile. So did this 40% drop make the stock cheap, or is it still expensive? And honestly, I think the only fair answer is that nobody really knows. And I say that as a Tesla shareholder myself. I keep a close eye on the business, and even I find it incredibly difficult to have confidence in my valuation models. It's tricky because, as we've discussed, it all comes down to the growth rate you apply. If you think the company will only grow at 10% per year for the next 10 years, well, my models guess that it's worth about $100 billion today, 88% lower than where it is now. But if Cathie Wood is correct and you add a whole nother business segment on top of that, that's generating 90% of their earnings in 10 years' time, and the business is gushing $200 billion of cash per year from its global self-driving service, then the value it was at just a few months ago seems pretty reasonable. And that's the thing, if you view Tesla purely as an automaker, then yeah, it looks overvalued. But I also believe there's more to the story, at least to some extent. Full self-driving, energy, AI, robotics, these could fundamentally change what this company becomes over the next decade. Now, I don't want to sound like a delusional fanboy, but we have to acknowledge that that is a possibility. But what I would say though is this: if you're thinking about investing in Tesla, you have to treat it as a long-term bet. This isn't something you can analyze like a hedge fund manager, stressing over quarterly earnings or expecting 10 billion in robotaxi revenue by mid-next year. That's not realistic, and you're going to hurt yourself. Remember, the beauty of being a long-term retail investor is that nobody's breathing down your neck demanding short-term results. You don't have to hit 10% returns in your portfolio this year to keep your job. You don't have to explain to anyone why your stock's down this quarter. You can zoom out. You can take the ultra long-term view. And if you're going to invest in a company like Tesla, I think that's exactly what you need to do, because when it comes to something like full self-driving or the Optimus robot, The timeline, in my opinion, is pretty unknowable. They're done when they're done. There are so many factors at play that it's almost silly to try and put a firm timeline on it. But for the long-term minded retail investors, what matters isn't when it happens, it's if it happens. But that also comes with its own risks because as we see today, a lot of the valuation is the expectation of future earnings. That's why Tesla has such a high PE ratio. And with that comes the risk that they don't achieve their goals. That is a risk to consider. If Tesla is unable to achieve that level 5 autonomy needed for a reliable robotaxi network, then you should expect the share price to fall even further than it has recently, because then they will be treated like just another automaker. Elon Musk has said this himself.
The value of Tesla overwhelmingly is autonomy. These other things are in the noise relative to autonomy. So I recommend anyone who doesn't believe that Tesla will solve vehicle autonomy should not hold Tesla stock. They should sell their Tesla stock. If you believe Tesla will solve autonomy, you should buy Tesla stock. All these other questions are in the noise.
But with that said, let me know what you think of Tesla stock in the comments section. And lastly, a reminder that if you are interested in that full step-by-step explainer of the discounted cash flow analysis, plus the whole Warren Buffett strategy, you can check out Introduction to Stock Analysis over on New Money Education. It's a 7-hour professionally researched, scripted and edited video course, and we'd love to see you guys over there. But with that said, leave a like on the video if you did enjoy it, and I'll see you guys in the next one.